we're coming to the final part of our discussion. We have touched a lot of macro politics, geopolitics, of course. So let's come to gold and briefly discuss gold and its portfolio characteristics. And what we can see here is, I think this perfectly relates to the previous comments. Actually, the world gold price is rising already since 2014, end of 2013. But in dollar terms, we're in this bull market that nobody is really seeing. Already since the beginning of 2016, we're seeing higher lows. And we should not forget that last year in dollar terms, when I talk to investors, nobody is really interested in gold at the moment. So the sentiment feels like gold is dead. But in dollar terms, gold was up 14%. Of course, we're seeing an extremely high correlation between the dollar and gold at the moment. It seems that it's mostly a dollar play at the moment, but that might of course change. But I think what's really important to say is that this is a bull market in the making. It's an early stage of a new bull market, and it's an asset class or currency, whatever, that nobody is interested in at the moment. I think it's really, we tweeted that out a couple of times last couple of days. The sentiment is as negative as it can get. We have seen very positive developments on the futures market based on the Commitment of Traders report. Sentiment is extremely negative, so that might probably might be a very good entry point at the moment. Now, as you know, Jim, we like having a look at relative charts, at ratio charts, because I think that gives you much more information than absolute charts at the moment, because everything is so much distorted by central banks. And on the relative basis, of course, you can see that compared to the equity market, commodities are dirt cheap at the moment. We know that markets tend to mean revert. So if there's some mean reversion happening, I think commodities and especially the precious metals should be a really good idea.
Well, I agree. This is a very good entry point for gold. Again, gold's had a bit of a tough slog recently, but I take your point, Ronnie, and I agree completely. You can't get too let your portfolio allocation decision making be too affected by what's happened over a week or a month. The behavioral psychologists have a name for that. It's called recency bias. We tend to be over influenced by things that have happened most recently and lose our perspective on the longer view. And again, I go back to the December 2015 low. We are, in my view, in a long multi-year bull market, which has very far to run. It will get to what I expect to be a $10,000 per ounce price. Who knows about the SDR price? Let's stay tuned on that. That has huge implications, by the way. I want to take our SDR discussion and put it in the context of what you're asking, Ronnie, which is the outlook for gold and commodities in general. There are sort of two ways for this to play out. If China wants to peg the SDR to peg gold to the SDR at 900 SDRs, right now, if the SDR were the only currency in the world, of course it's not, but if it were, they would have enough gold to make that stick. But what's going to happen in a new financial crisis if the central banks are tapped out, if you can't go to QE4, QE5, and QE6 because you're in danger of expanding your balance sheet into the, maybe the $10 trillion level, at which point I think you probably pass an invisible confidence boundary and destroy confidence in the dollar itself. If the SDR is the only source of liquidity in that scenario, then how does that stack up against the peg of 900 SDRs to an ounce of gold? Well, there are two answers. Number one, it doesn't. that you picked the wrong price and you've got to let the SDR value go up to, 8,000 or 8,000 SDRs or whatever, something equivalent to $10,000. Or you'll say, hey, here we are, IMF, we got all the SDRs you want, you have to give us gold. You can get your SDR liquidity, but you have to give us gold if you want it. At which point, what does the United States do? Does the United States open up the vault of Fort Knox and say, okay, here's a couple thousand tons of gold, you leverage 2.5 to 1, give us some SDRs because we're broke. I mean, these are all down the road scenarios, but it will play out in one of these ways because there are no other ways out. The U.S. simply cannot pay its debts. And you don't have to. The U.S. has never, with the exception of 1 year, 1835, during the administration of Andrew Jackson, the U.S. has never paid off the national debt. What we are good at is rolling it over. But rolling it over depends on confidence, and confidence is being destroyed because the fiscal situation in the U.S. is totally out of control. And so there are only two ways out: default, which is not going to happen because we can print dollars. The other one is inflation. Well, if you see the inflation coming, you want gold. Because gold is the ultimate inflation hedge. And so, you can talk about an SDR peg, you can talk about breaking the SDR peg and hyperinflating SDRs, you can talk about hyperinflating in dollars, you can talk about a depression, which I think we're in anyway. And you made the point earlier that gold does very well in recessions. Some people don't understand that, but just go back to the Great Depression, 1929 to 1933. I mean, by a lot of definitions, the Great Depression lasted until 1940, and I agree with that. But the most acute phase was that 1929 to 1933 period. Gold went up 75%, from $20 an ounce to $35 an ounce. In other words, gold performs extremely well in depressions and severe recessions. And there's a reason for it, which is countries are desperate to get inflation, and there's no faster way to get inflation than to devalue your currency against gold, and therefore gold goes up in nominal dollar space. Best performing stock on the New York Stock Exchange during the Great Depression was Homestake Mining.
Yeah.
So you do have this evidence that gold does very well in inflation. Everyone knows that intuitively, but the evidence is that gold does very well in deflation, at least extreme deflation, because governments are desperate to get out. And the U.S. is going to have inflation because there's no other way to pay the debt. So every way I look at it, gold goes up. Now, does that mean tomorrow? Not necessarily, but if it's depressed right now, what a great time to buy.
Yeah, exactly. Yeah, just constantly accumulate. And we're actually already coming to the final slides. What we can see here, gold as a pretty good safe haven buy. How it performed in local currencies versus the local stock market. Of course, in US dollar basis, it was doing okay, up 6%, while the S&P was down 38%. But in some other currencies, like the Canadian loonie, for example, up 30%, while the stock market was down 35%. Even more extreme in Russia, and so on. So I think that's also a message that is really important from our gold report. We don't want people to allocate all their capital into gold, but it just makes sense from a portfolio perspective to at least hold some gold. And that already brings us to our scenarios for the gold price that we are also describing in the gold report. Mark, this is something that you're really good talking about, our scenarios that we're thinking about.
Yeah, I can finish up this very interesting call by describing the thoughts which we put into the scenarios, and we defined the scenarios in terms of time horizon as this administration. So by the end of 2020, we are talking about these price ranges for 4 different scenarios. Why did we choose this one? Because we think also not only that the administration is in power till 2020, most probably at least till 2020. The monetary normalization, which is obviously very important for the gold price, perhaps we can get a grip on if this monetary normalization really was able to be done by then. And because by then we should be kind of in a more normal, whatever that means, balance sheet, at least according to the path which the Fed has entered. So scenario A would be, in our view, it would require a genuine boom with real growth, which is larger than 3% per annum, which then again allows the Fed to really follow through the monetary normalization. And at the end of this phase, they can say, okay, success, balance sheet is between, say, 1.5 and 2.5 trillion US dollars. It was basically normalized. That obviously wouldn't be a very good scenario for gold. We estimate something like 700 to 1,000 price range. Obviously, we see a lot of risk to this scenario because we think this tightening, as we discussed, is actually already the risk of this for this genuine boom and genuine growth scenario. Scenario B, this is basically where we are right now. I'd say we are still muddling through. We have growth and inflation rates between 1.5 and 3%. Until now, we haven't completed the monetary normalization. Actually, that's also the price range where we are still in today. So that's 1,000 to 1,400 US dollar price tag we put on this scenario. And then the more likely scenarios in our view would be either scenario C. Perhaps we can get really an inflationary boom, growth, and inflation is greater than 3%. That probably will mean that monetary normalization will not be able to be completed by 2020. Which brings us in a price range of 1,400 to 2,300. That's what we estimate. Or, and this is scenario D, it could be an adverse scenario. So we can either have a growth which is very meager, or even a contraction, a recession, which most probably will lead the Fed to pause the normalization or even to renew easing, and then that range gets really broad. Then really a lot of different outcomes are possible. One of these adverse scenarios would also be, I would suggest, something we talked about today as well, being some kind of a reset of the monetary system. So this is what we are really putting actually together 18 months ago, I think, or 16 months ago, and we stuck to these scenarios again, going to looking at end of 2020. Any final comments on that, Jim?
Well, no, I think it was very well stated, Mark, and very thorough. I agree with the analysis. I especially like the way you've got different scenarios rather than forecasting one outcome. You said, well, there are a number of outcomes, but here's how gold could be expected to perform in each one. So that's a much more helpful and realistic way of doing forecasting than putting a stake in the ground. And as far as my forecast of $10,000 gold is concerned, I always point out, well, you have to get to 5,000 or 2,000 or even 1,400 before you get to 10,000. So I don't disagree with any of the forecasts.
Well, Jim, thank you very, very much for taking the time. I think it's been a really fascinating discussion again. Yeah, thank you for being member of our advisory board. Thank you for being a friend and also a mentor. We really appreciate it. Also your kind comments about the report. And we're already truly looking forward to your upcoming book.
Thank you very much.
Thank you very much, Jim, and I hope you listeners all enjoyed it. You can find the download link to this year's In Gold We Trust report below. And yeah, thank you very much for taking the time.
Take care.